Hey traders, Raghee here, and in this update we're going to talk about the Vix Futures, bond futures, and the XLK sector, all right, and how that maps to likely where the S&P futures and the NASDAQ futures could be heading next. So let's start off with the VIX. Now, there aren't a lot of market internals that I'm a big fan of, but the VIX is not just a market internal. It's actually a futures contract. So this is something that I like to look at in terms of these inflection points in what is usually a very back and forth choppy futures contract. If you take a look at the VIX throughout 2022, you'll see I've used the Darvis 2.0, actually this is Darvis 3.0, to identify the upper ends of the range. And I can move this one down here. That was an older level, but that's a good level to watch. But here are the Darvis resistance levels. We have some Darvis support levels. This one here in the middle around 2582 has been tested on the 4th of May, the 17th, and now we're closing in on testing again this week as we round out the month of May. And then if we were to head a little bit lower, you see the range extremes, the very bottom to the downside, which we haven't seen, by the way, since back in April. It seems that the whole shift has gone to this 2580 area support and then resistance between about 33, about 34 to almost 35, right, to the upside. What does that mean for us as traders? And I also want to point out we're getting another Darvis 3.0 signal, Darvis 3.0, Darvis 3.0. The signal is not enough. We really want to see, for confirmation, today's high get broken to show that this VIX is about to move back up into the range that really we have seen for going on a month and a half now. The VIX coming down to this level is likely, if it's going to react in any way similar to what it's done before, it's likely going to trigger some support and the VIX moves higher. What's going to happen if the VIX moves higher? You guessed it, we're going to see pressure on equities. But before we get to the equities, let's take a look at the bond market. The bond market, which often likes to play a game of chicken with the Federal Reserve in terms of oftentimes, if you're going to see a market where its participants want to play a game of chicken with the Federal Reserve and their monetary policy, or even try to front run what we're seeing in terms of monetary policy and action, it's the bond market. And by front run, I mean making a bet before we really have a lot of evidence that there's going to be a switch in monetary policy or the way in which they're hiking rates. Front running simply means we're trying to jump ahead of the process. And jumping ahead of the process really by definition means we haven't let the process complete. So if we have an incomplete theory on why the Federal Reserve might have to tap the brakes on higher rates or might change their tone about the hawkishness, bonds will often be where that sentiment, that idea is front run. But remember, front running means we do not have a process that has completed. Hence, we're front running. We're getting out ahead of that completed idea, that completed plan. And that is a very bad way to trade. Please don't do it. If you have a process, follow it through to its completion. Don't front run your own process, right? And I think a lot of bond traders believe that there was probably a shift in monetary policy and or messaging coming, hence they did what they did. And we can see now that if we can ever look continuation versus reversal as an octagon match, reversal, right? What's the chance that a market puts in a V or U bottom as opposed to continuing in the direction from which it came? So downtrend, little bounce, stall. Would I presume it reverses and goes higher? Or would I presume a continuation? We're going to presume the continuation. That's the higher probability situation. Yes, the Federal Reserve and switches in monetary policy can put in these types of V bottoms, but there's been no shift. So for now, I'll play along with the trend that's still very much in control. Realize that we don't have a single green grab candle with all that rally, with all that strength. Not a single green grab candle in the long bond. All right, moving on. So we're going to stick with the short the rip. Now, 10-year was a little bit more of a bounce. One green grab candle, but again, respect the trend that was. This is IEF by way of the ETF alternative or the ZN futures. And yes, IEF hasn't been quite as much in terms of the resumption of the move to the downside as we saw in TLT, but it's definitely looking like it wants to continue. So what are the ideas so far? Look for an oversold bounce in the VIX and look for continuation on both ZB and ZN, which maps out to TLT and IEF. And that brings us to the XLK. Now you might say, okay, futures video, we're going to talk about a sector? Yeah, we're going to talk about a sector. We're going to talk about a sector, and the most important stock in that sector is Apple. Apple's in a downtrend, gang. Apple, as much as some of the other bounces we've seen have exceeded the wave, have gotten above it, have printed blue grab candles, even some green grab candles, Apple has done none of that. And Apple is the most heavily weighted stock in the XLK. The XLK is the most heavily weighted sector in the NASDAQ, the S&P, and also a heavily weighted, not the most, but the second most heavily weighted sector in the industrial average, Dow Industrial Average, or the Dow, right? When we take a look at the indices and we think about the influence XLK has, it's an outsized influence because not only are stocks high concentration weighted in indices, but sectors are too. It's not as if the sectors are balanced and equal in their influence and weighting. They're not. They're high concentration weighted as well. So it's very important for traders of the S&P and the NASDAQ to respect where XLK, Apple, and even Microsoft are heading. If Apple's in a downtrend, XLK is going to have a very difficult time organizing into even chop. That means S&P is going to have an exceedingly difficult time organizing into chop or even an uptrend. So the components are the stepping stones to where the broader average is going, right? Whether that be the stepping stone of the sectors, the stepping stone of the high concentration weighted stocks within them. And looking at bonds, looking at VIX, and then now looking at XLK, this is why I say, especially when it comes to the NASDAQ and secondarily when it comes to the S&P, this is why we're going to head lower. Are we going to see new lows? I'm not ever going to presume that. But I am expecting fatigue in the market to start heading lower again. And if we head down to 11.5 on the NQ, we head down to, this 3,800 area on the ES, we should be taking profit well before that. So I'm not talking about new lows. I'm just talking about reaching resistance and heading back lower. And then rather than saying this is what I think and this is what I feel, no, this is what I see and this is what maps to the decisions I'm making. Now, later on this week, on Thursday, this is a longer term conversation about trends. But let's face it, it's been difficult to get follow through. This has definitely plagued me as well. And the adjustment that I'm making personally is I'm doing a lot more intraday trading. So on Thursday, we'll talk about how we can shift gears and look at a 5-minute time frame, look at 2-hour blocks of the day as traders and say, look, I don't need follow through day to day. I certainly am not looking for follow through week to week. Can we get follow through for 30 minutes, 60 minutes? Can we get follow through that gives us an opportunity to grab a short on a choppy, if not somewhat bullish day? Can we get the opportunity to grab a short and take a little something out of the market and then be done within a very finite period of time, right? That's the benefit of day trading, being nimble and not needing longer term organization. So we'll talk about that on Thursday. I also want to let everyone know that we have a webinar coming up. I know it seems far off, but if you're anything like me, you like to have your planner scheduled ahead of time. It's on the 16th of June. So really just about 2 weeks away. We have our first webinar where I'm going to talk a little bit more about my day trading. I'm going to talk a lot more about these tools that I've created over the years called hourly price movement ranges, and why time and volatility and day trading right now has been sort of the shiny spot. Since we've seen a lot of the volatility in the broader averages, it's been the shiny spot in my day trading. Put a big heart around time and volatility. And you'll see why when we start talking about it. But I'm going to give you a sneak peek of a lot of this on Thursday with the hopes that it's going to help you navigate the beginning of this month a whole lot easier. All right, gang. If you have any questions, if you have any comments, if you have any requests, feel free to leave them in the comments below. Thanks as always for watching. Thanks as always for smashing that like button. And I'll see you all tomorrow morning at Charts and Coffee, 9 a.m. at the Simpler Trading YouTube channel. We wrap up so you can head right into the rooms at 9:20. So I'll see you for our 20-minute pregame show in the morning. Be good to each other, gang. Hey traders, Raghee from Simpler Trading. Thank you so much for watching this video. Be sure to leave a like and a comment below. And remember, subscribe and click the bell icon so you'll get notified of the next update. And when you're ready to join me for live trading, be sure to head on over to simplertrading.com. I'll see you in the next update.